Hello everybody, this is David Blair, the Crosshairs Trader. First video I did this year, 2011, I talked about those who trade the there it wasers. In other words, it's those who look at a chart, see that a stock is having a good run, and trade it in the direction of that run, not realizing that the risk is much higher to get in after there's already been a long run. So we basically look at a trade that is breaking out, beginning a run as a there it is, one that has already had a long run and is in need of a rest as a there it was. Those who trade the there it was are trading off the emotions of not wanting to miss out. They're also trading on looking at a chart and seeing it after a move has already taken place, whereas those who trade the there it is are trading off good technical analysis, little emotion, and looking at the risk reward ratio as being in their favor. So I went through several stocks at that time that, due to either price resistance on a weekly chart or high candle count, which is something I developed on the weekly chart, we should not have gotten excited over any type of possible move on the daily chart. One of the principles that we crosshairs traders apply to help us control our emotions is to make sure that when we see a trending stock on the daily, whether we get a signal, a breakout, an itch as we call it, which is an intraday crosshair or a crosshair, that our software fires, even if we get one of those signals, we always look at the bigger chart to see if there's anything that we need to be concerned about. Well, one of the things, or two of the things that we need to be concerned about, is whether or not there is price support or resistance, or whether or not the candle count has gotten too high. And if so, the risk is just not worth the possible reward. So we would rather step aside and not trade that in the direction of the trend that it's had. Instead, we look at other opportunities, or for those who like to trade extended moves, look at it as an opportunity to go short, to buy puts, or even sell calls for those who do that. So let's take a look at the ones that we went through. I'm going to go through the same ones again and quickly just take a look at where they are since we discussed them. But just all but two or three of them have either been showing weakness, or they're in an area where they haven't really moved much, or doing more consolidating than continuation of the trend. There are a couple of exceptions, but out of these 20 or so stocks, all but a couple of them are showing some weakness and some volatility after a long move. Let's begin with WLT, Walter Energy. You can see my vertical line here is where we were when we looked at the stock last time on January the 1st, and you can see now that we have dipped below where we were. So those who were looking to get in long here, the there it wasers, are now in trouble as it begins to pull back. Next would be CY. Again, CY continued to move higher, and now it's starting to pull back. So this is one that at the beginning did not show any weakness, continued to go higher, but now is rolling back over. So that's one out of this group that has gone higher but now pulling back. CHKP, again, we can see here that since January 1st, or January 3rd really, first trading day of the year, we are now pulled back and going lower. SWKS, same thing. We made an advance, but now we're already back to where we started. Not much of a move. TKR, all the way back to where we started, beginning of the year. CMI. I'm not one who believes that you can find tops and bottoms. I don't believe it's possible. All that we do here is look at whether or not a move has the potential to make us multiple dollars and not be a concern as far as a quick rollover or in an area where it's more likely to consolidate than trend. We simply want to put the probability on our side and lower the risk. And so far you can see where it just has not, none of these trades were really in an area where we felt like it was a very high probability, low risk, high reward area. CMI rolling over. BWA rolling over. BEXP rolling over. Actually, let's move this up here. EL is one that hasn't started rolling over, but still at a very high concern area. It's starting to look a little weak. OVTI rolling over from week 1. NVLS has continued some strength since then. It's the only one that's really showed a lot of strength. Now it's starting to pull back some. PH, Parker Hannifin, right back where we started. ROK, just about back where we started. Right there at it. PAAS, our silver stocks, gold stocks, all of them have been taking a beating. And you can see that here. UTX, again, these are the there it wasers. They're looking at a chart. They're seeing there's been a great move. May have even been a signal on the daily. May look good on the daily, but then when we look at the weekly charts, they're extended. I'm not showing the weekly charts, but the daily where the weekly chart would have formed. You can look back at the previous video, but you can see where there's just been an extended move. You can see that on these daily charts, and it may just be time to sit back and wait. SWC, again, not really moved too much, about where it started beginning of the year. KO has rolled over hard here at the beginning of the year. JNPR, now we're on a roll. JNPR, FCX, all of these have taken a beating. Doesn't necessarily have anything to do with the news. It's simply that stocks, when they get overheated, they have a tendency to pull back hard and correct, and that's where we decide to stay out, not trade them, or either for those who choose, trade the opposite direction. DDS had a nice move up. Now it's starting to come back again. And CPWR was one that I used as a screenshot illustration, and you can see that now it's back as well. Many times you'll see these extended moves break out in an area, trap a lot of bull traders, and then reverse. But what we learn is when there's an extended breakout, those are the ones that we need to be cautious about and stay away from. Those are our there it wasers. Those who were trading these were the ones who got in at the very end of a possible move. Out of the ones that we went through, there were 3 or 4 that are still above that area, but all the rest of them have started to reverse. Doesn't mean they're going to necessarily go down for weeks or months now that the trend has reversed. It just means now is a good time for it to rest. We crosshairs traders will, of course, if they show up on our radar screen as an up trade, we'll know that they've had their rest and be able to trade them accordingly. If not, we can start looking for them on a down move as they begin to run down and then retrace back and run down again. Basically, when we look at down trades, we simply turn our computer monitors upside down, and instead of trading them in these waves, nice waves going up, we turn them around and trade them this way. Very simple. Very simple analysis. We trade the same patterns over and over again in both bullish, bearish, and sideways markets. If you're interested in finding out a little bit more about crosshairs trading and how to stay away from these there it wasers and how to find the high probability there it isers, please contact me at david@crosshairstrader.com. Love to invite you to one of my members only webinars. Continue to visit my website. Love to have you reading my blog posts. They are free. All right, I appreciate you. Appreciate your time. Appreciate your interest. And have a wonderful day both in and outside the charts.